So one thing that I like to do is to keep up with training on the student aid website. So before I go through this training, actually I went through this training. I'm going to do a separate video on the loan origination and disbursement provisions, but I want to talk about loan repayment and servicing provisions. We know with the passing of the One Big Beautiful Bill Act, there's going to be a lot of changes to student loan repayment that are coming in on July 1st, 2026. And there's some things that borrowers may have to do prior to that time. So let's go through this training together. That way we can see exactly what is actually happening, okay? So, like I said, this is free training that the FSA offers. So this is under loan repayment and servicing provisions. And it tells us that the One Big Beautiful Bill Act made a number of changes to loan repayment and servicing, while school financial offices and other entities should be aware of these changes. They will be most impactful for federal direct loan borrowers. This lesson reviews the following: updates to income-based repayment, changes to repayment plans, modifications to deferments, forbearances, and loan rehabilitation. So, if you have federal student loans, federal direct, you want to make sure that this is some information that you're getting. So updates to income-based repayment. Upon enactment on the 4th of July, the law updates the entry criteria for borrowers to qualify for income-based repayment plans. There were two significant changes: the partial financial hardship. To have a partial financial hardship, a borrower must meet a certain threshold under a formula that looks at income and family size. Prior to an enactment of the One Big Beautiful Bill Act, a partial financial hardship was required to enter an IBR plan. The law removes this requirement, and borrowers no longer need partial financial hardship to access IBR plans. A borrower's monthly payment while in the IBR will continue to be capped at what the borrower would have paid under a standard repayment plan. So prior to the passing of the One Big Beautiful Bill Act, in order for a borrower to qualify for income-based repayment, there had to be a partial financial hardship. Well, with the passing of the bill, that's no longer a requirement. Even though it was a little rocky start, there were borrowers who were still attempting to apply in the system due to system updates and things of that nature. They were unable to. There's a latest status report that just came out on the 13th, so 2 days ago of February, that shows where the Department of Education is with processing income during repayment plan applications, Parent Plus, I'm sorry, not Parent Plus, public service loan forgiveness, buyback requests, and also discharges under different repayment plans like income contingent repayment and pay as you earn. Go back and read that. I was actually just looking at that. Let me show you real quick. These are the numbers. If you haven't, these are the numbers here where they are. Income during repayment plans. All of this information is here that you can see. Okay. All right, let's go back to the training. They tell us that for Parent Plus loan borrowers, before the passage of the bill, Parent Plus loan borrowers who had consolidated their loans were only eligible to enter the income contingent repayment plan, which is less generous than the IBR plan in terms of payment amounts and cancellation timeframe. But with the changes, parent borrowers with a direct consolidation loan who repaid one or more Parent Plus loans can now enroll in IBR if they were already enrolled in ICR. Note that borrowers will have to enroll in ICR no later than July 1st, 2026, and make at least one payment under ICR before allowing them to enroll in IBR. So basically, if you are a Parent Plus loan borrower, and let's say that you have those older student loans, those FFEL loans, loans that are not federal direct loans, you also will need to consolidate those loans. There's a consolidation process that has to take place, and that has to be done. That disbursement has to take place prior to that July 1st. So they want that disbursement of that new consolidated loan to be dispersed at least by June 30th, 2026. But what the Department of Education is actually stating is that if you need to do a consolidation for Parent Plus loans, is that you want to get that done at least 3 months prior to. So that means until next month, the end of March, that consolidation process will need to be taking place just to ensure, because we see the backlog, just to ensure that everything is processed, because you also have to get enrolled. You don't have to get enrolled into a repayment plan until the 1st of July, but you just want to make sure that you retain that eligibility. Also, be sure if you have Parent Plus loans that you're not consolidating non-Parent Plus loans with your Parent Plus loans, especially because of the provisions that are under Parent Plus, and you have more access to other repayment plans outside of Parent Plus loans for your other type of loans that you may have taken out for yourself. Tells us the above provisions became effective on the 4th of July. The department is actively working with its federal student loan services or federal loan servicers to implement the changes as quickly as possible. ED will update their website when affected borrowers are able to enroll in IBR as prescribed by law. So you are able to enroll in income-based repayment. This might be a training that hasn't been completely updated. I need to look at the date. Changes to repayment plans. The law updates repayment plan options in a number of ways. It creates a new standard repayment plan referred to in the rest of this training as the tiered standard plan. This plan will be available or must be available by July 1st, 2026. It creates a new plan called the Repayment Assistance Plan, also known as the RAP plan, which also must be available to borrowers by July 1st, 2026. It outlines transition plans over the coming years for borrowers to move out of certain legacy repayment plans. So when they talk about the legacy repayment plans, those are the plans that are currently available, like pay as you earn, the SAVE plan, which currently borrowers who are in the SAVE plan are in a forbearance. You're not able to make any payments under that plan. You're not getting any credit towards forgiveness, but that is still a plan that is technically you can still see, but you can't actively enroll in it. Um, Income-based repayment and then also income contingent repayment is still technically available. But what's going to happen is those plans are going to be phased out. Income contingent is going to be phased out. The pay as you earn is going to be phased out. And then, of course, the SAVE plan. These plans will all be phased out at least by the 1st of July, 2028. Let's talk about repayment plan details. Let's walk through a few details of the changes that the bill made to repayment plan options. So it tells us about this new tiered standard plan. The tiered standard repayment plan replaces all fixed repayment plans, including the existing 10-year standard plan and consolidated standard plan. It will have a repayment term with a sliding scale based on the outstanding principal loan balance at the time the loan enters the plan. So this is where they tell you if your outstanding principal is less than $25,000, you're looking at 10 years on that plan. So this plan is structured for you to pay your loans off. Okay, so when you go into the standard plan, this is what will happen if you have a Parent Plus loan that is not consolidated into a direct loan. This is what the only plan that you'll be eligible for after that July 1st or July 1st, 2026, if their loans aren't consolidated. This is the only plan that you will have access to. So they tell you what your repayment terms will look like depending on what that principal balance is. Let's see, the repayment assistance plan. This is the RAP plan, the new plan that was introduced under the passing of the bill, the One Big Beautiful Bill Act. They tell you that it's fundamentally different from the existing income-driven plans in the way a borrower's monthly payment is calculated. We're going to dive more into that. Loans made on or after July 1st. So if you borrow after July 1st, on or after July 1st, what that means is that they say once a borrower takes out a new loan on or after July 1st, 2026, the borrower is eligible to repay under only one of the two repayment plans outlined, the tiered standard plan or the repayment assistance plan. This includes a borrower consolidating after the 1st of July, 2026, even if underlying loans were made before that time. So even if you have loans currently, if you borrow anything in addition after the 1st or on or after the 1st of July, 2026, you would only have access to the repayment assistance plan or the new tiered standard plan. All direct loans must be repaid under the same repayment plan. Please note that there will be some exceptions to this rule based on borrowing history, types of loans, etc., which will be communicated in the future. Loans made before the 1st of July, 2026. If all of your loans were made before the 1st of July, the borrower will still have access to these repayment plans: pay as you earn, income contingent, SAVE, revised pay as you earn, income-based repayment, the legacy standard plans, extended repayment plan, and graduated repayment plan. If a borrower takes out more loans after this, you will lose access to these plans. This includes any consolidation loans made after the 1st of July. Note, all SAVE borrowers are currently in forbearance and access could be affected by the court decision. So we know that there's an injunction against the SAVE plan. There's different court actions that are going on currently. And basically what they're saying with this is depending on what happens within the courts can determine when that forbearance that borrowers are currently in will stop, meaning you'll be put back into repayment. We know, again, pay as you earn, income contingent repayment. Also, these plans will be gone by the 1st of July, 2028, somewhere between now and the 1st of July, 2028. We know as far as with the SAVE plan, that could change at any moment based on court action. Transitioning from certain existing plans, borrowers who have loans in income-driven repayment plans listed below have until July 1st, 2028 to enroll in another repayment plan, including IBR or RAP. And this is these plans: pay as you earn and income contingent plan. Borrowers who not make a selection will be enrolled by the department in either IBR or RAP, depending on your loan eligibility. So, if you are in any of these plans, you have until the 1st of July, 2028. Up until then, if you don't make a selection, that means they're going to go ahead and transfer you into one of the plans that you qualify for that's available, either income-based or the repayment assistance. Public service loan forgiveness, payments that do count towards public service loan forgiveness under the provisions of the passing of the bill. Full on-time payments made under the repayment assistance, or so under the new RAP plan. Payments made under income-based and revised income-based repayment. Payments made under Save, Repay, Pay, or ICR before July 1st, 2028. So here's what's interesting because they say payments made under Save. We know that the Save plan right now, currently there's an injunction against it. So if you're making any payments while you're in a Save plan, it's not counting towards anything. You're not getting any credit for it, towards public service loan forgiveness or towards forgiveness in general. So in order for those payments to count, that means you would have to transfer out of the Save plan. So one thing I can take this to mean is that when they say payments made under Save and Repay or just the Save plan, is they're talking about under the buyback process. That could be the only thing I could see that they mean by that. They just didn't say it, but any payment that you make under the Save plan doesn't count. It doesn't count. It doesn't constitute as a qualifying payment because it's technically an ineligible repayment plan because of the injunction that's against it and the forbearance. And in order for, you know, public service loan forgiveness is a two-part program. It's connected to not only the type of employer that you work for, but also the payments that you're making toward the loans are being made under a qualifying repayment plan. And because of the forbearance, that means that Save is not technically a qualifying repayment plan unless you go through the buyback process to buy back the time that you have spent in the Save plan. But when we look at the recent report and you look at the buyback applications received during the month of January, this is the amount that's decided, approved, and denied, 20 over 24. But then we've got approved and denied, closed without decisions, and we've got this many pending as of January, so over 86,000. Okay, so we know it's a process even with that. All right, let's go to the next. All right, let's walk through how a borrower's monthly payment plan is calculated under the new repayment assistance plan. All right, so let's get down to the calculations. So they tell you how, I'm sorry, I thought I would stop recording. The first step is to look at the borrower's adjusted gross income. If the borrower files taxes as a married filing separately, the spouse income is not used. So they tell you how your AGI is and then what your base payment is going to look like. So if your AGI is no more or not more than 10,000, the base payment is 120. As it goes up, 10,001 to 20,000, 1%, so forth and so forth, okay? So next thing you'll do is divide the base payment into months. So in the second step, the base payment is divided by 12 because there's 12 months in a year. Determine monthly payment amount. And finally, to calculate a monthly payment amount, the amount from step 2 is reduced by $50 for each borrower's dependent. Dependents are based on the IRS definition. The calculation will use only dependents claimed on the borrower's tax return. If the monthly payment amount is less than $10, then it is set to equal $10. So if you have dependents as defined by the IRS, you'll get a reduction of $50 for each dependent that you have. All right. But if that monthly payment is less than $10, then you're set to equal $10. So you know that you'll at least be paying $10 a month at the least. So it tells us, let's look at an example.